Hey everyone, welcome back to Corporate Decoder. Today we're diving into a new spin-off company called Curbline Properties and their first annual report. A spin-off means they used to be part of another, bigger company, Site Centers, before going off to do their own thing. Now I know what you might be thinking. Real estate reports. That sounds thrilling as watching paint dry, but stay with me, because some interesting risks and strategies are at play here. Curbline is all about convenience shopping centers, those smaller, everyday needs retail spots you see on the curbline of well-trafficked areas. They're claiming to be the only publicly traded company that is completely focused on them. That could be an opportunity or a risk if they don't do well in a new sector. At the end of 2024, Curbline has 97 of these convenience shopping centers totaling around 3.1 million square feet. They were about 94% occupied and making an average of $35.62 per square foot in rent. Most of their properties were in the Southeast, Mid-Atlantic, and Southwest, plus Texas. Curbline officially separated from Site Centers on October 1, 2024. Site Centers handed over 79 shopping centers along with some other things. In exchange, they had to give their shares of Curbline to shareholders of Site Centers as a kind of special dividend. Curbline's main game plan is to grow big in the convenience shopping center market. They believe there is a big fragmented market with small owners that they can aggregate, so they look to acquire new properties and also improve the ones they have. Curbline wants to acquire assets, but they are also targeting a group of primarily national, high credit quality tenants. Think Starbucks or Chipotle because most of their properties are on the small side. The median or typical property size is just 20,000 square feet. Curbline likes leases with shorter terms, meaning they can adjust rents more frequently. They also want to limit tenants' renewal options. Curbline says that they will see a better increase in cash flow compared to other retail properties because of these things. Between January and February 2025, they acquired 2 new shopping centers for around $7.7 million. They claim to be a very diversified portfolio, and the top 10 tenants comprise less than 13% of their total revenue. The largest is Starbucks at 2.4%. Curbline faces a lot of competition in attracting tenants in the real estate world, big and small, and the real estate world comes with interest rates, property conditions, and overall location. Curbline states that they focus on employee training modules on sexual harassment and discrimination and acknowledge and certify their compliance with the company's code of business conduct and ethics. Like any company, Curbline has its fair share of risks they have to disclose. Being new with a limited track record means Curbline isn't sure if it will be able to scale its business successfully or if it can even put its business plan into action. It is also hard for investors to know if the company is doing well without a long-established history. Because Curbline used to be part of Site Centers, what we know about how they performed before isn't necessarily indicative of what they might do now. This is because the spin-off has changed their structure and business operations. Their economic success depends on a lot of things they can't control. Inflation is also a concern as this can increase construction costs, operating costs, and other expenses, even if they cannot get the same revenue. Some costs like utilities or insurance might remain constant even if they are making less. Growth through acquisition can be difficult because they might not have enough people to scale the business. They might spend too much on evaluating acquisitions that will never happen, and they might just have a hard time finding good acquisitions, which would affect the value of the company. Curbline still has ties with its former parent, Site Centers, and that creates certain conflicts of interest as the company's CEO also serves as a director of Site Centers. The deals they made with Site Centers might not have been as good as they would have been if they were dealing with a completely separate company. Also, Site Centers might fail to qualify as a REIT, and this could cause Curbline to fail in that qualification too. As a REIT, they are in many ways subject to various restrictions. For example, they generally must distribute to stockholders at least 90% of its REIT taxable income each year. Therefore, the company may need to sell its securities at unfavorable prices, borrow funds, or find other sources of funds in order to meet the REIT distribution requirements. Curbline's stock prices could also be volatile. As a final note, Curbline depends on information technology systems and is always at risk of cyber attacks that could harm the business. So what's my take after decoding all this corporate jargon? Curbline is stepping into a pretty unique space, convenience stores, and they are correct that there seems to be good demand for it, but there's a lot of dependence on site centers, which doesn't inspire a lot of confidence. The real estate itself is okay, but it is not amazing. One thing investors should watch closely is the leadership, since there are a lot of shared leadership positions between site centers and Curbline, and that could raise a lot of potential conflicts down the road. Another watch point is there is no guarantee for dividends, as the company could adjust business and strategies, which could affect whether you even receive dividends. Ultimately, Curbline Properties is a high-risk, potentially high-reward stock. It is also a very small portfolio, and the results can vary wildly in its early stages. With that being said, it is not the most promising long-term play, but it will depend on its performance. If you made it this far, thank you for watching. If you found this interesting, please subscribe and like.